Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IBM.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So we really need to talk about the sheer violence of what just happened in the markets. I mean, I was looking at the tape for Big Blue, and falling off a cliff feels like an understatement.
Oh, it's an absolute bloodbath.
It's more like the cliff crumbled underneath them and they took the elevator straight down to the basement.
Yeah. Looking at the action specifically on February 23rd, 2026, which was just yesterday, IBM was down 13% in a single trading session.
13%.
Right. That is a move you expect from some pre-revenue biotech stock waiting on an FDA approval, or maybe a crypto altcoin that just got delisted. You do not expect that from the blue chip grandfather of technology.
It's brutal. It really shakes the foundation of what you consider to be a safe stock. And if you zoom out just a hair, it gets even uglier. They are down roughly 27% for the entire month of February.
Which is capitulation? Pure and simple. To put that 27% into perspective for everyone listening, for a company with IBM's massive market cap, we are talking about billions of dollars in shareholder value, just vaporized in weeks.
Gone.
I actually dug into the historical data this morning because I couldn't believe my eyes. We haven't seen a sell-off of this magnitude for IBM since the dot-com bubble burst back in the year 2000.
It is a historic crash. We're talking about a quarter-century event here. And usually when a stock that is historically as boring, and let's be honest, stable as IBM makes a move that violent, it signals one of two things.
Right.
Either the market has finally realized the business is structurally obsolete, like a blockbuster video moment.
Well, it is the sale of the century.
Exactly. That's the golden rule, isn't it?
It is. When a blue chip dives 27% in a month, you don't just run away screaming. You have to look under the hood. You have to ask yourself if the panic is mathematical based on a real loss of future earnings or purely psychological. So let's peel this back a bit. What was the match that lit this fire on February 23rd? Why did everyone head for the exits at the exact same time?
It's the AI narrative, but with a very specific, very sharp twist. It wasn't just the general, AI is the future buzz. It was a specific player entering IBM's backyard and threatening their oldest, most reliable revenue stream.
Anthropic.
Right. The panic started the second Anthropic announced their new tool, Claude Code.
Claude Code. Now, for the uninitiated, this isn't just another chatbot asking for a recipe or having it write a poem. This is an agentic AI. But why did this specific release terrify IBM shareholders so much? Like, what is it about Claude Code that screams, sell IBM?
Well, because Claude Code is being touted specifically as an expert at modernizing COBOL.
COBOL, the ancient language of the financial gods.
Yeah, the code that was written before a lot of our listeners were even born. And this is critical to understand if you want to get why the stock tanked. COBOL runs virtually every major bank, insurance company, and government mainframe in the entire world. It processes trillions of dollars in transactions daily.
Every time you swipe a credit card.
Exactly. If you swipe a card or withdraw cash from an ATM, you are interacting with COBOL. But it's old, it's clunky, and the human beings who actually know how to write it are literally retiring or dying out.
And that scarcity is usually IBM's biggest advantage, isn't it?
Precisely. IBM makes an absolute fortune, literally billions, providing the human consultants and the engineers required to keep those legacy systems running. It is high-margin, sticky service revenue.
I see. So the market connected the dots instantly. They thought, okay, IBM charges billions for human consultants to maintain or rewrite this old code because it's hard.
Yep.
And suddenly Anthropic says, hey, our AI agent can rewrite that old code into modern Java or Python overnight for pennies.
That's the fear. It's the AI displacement theory hitting the services sector hard. The narrative that formed was that IBM's bread-and-butter consulting revenue is about to get automated away entirely.
You saw the headlines everywhere.
Oh, yeah. IBM sinks most since 2000. AI threat decimates legacy tech. It was a perfect storm of sentiment shifting aggressively against the old guard. The perception is that IBM is the horse and buggy, and Anthropic just rolled up in a Model T.
It makes sense why that narrative took hold so quickly. If your business model relies on complexity, and AI solves complexity cheaply, you have a massive problem on your hands. But it wasn't just Anthropic, was it? The macro picture hasn't exactly been sunny for hardware stocks lately either.
No, it hasn't. We're still dealing with broader tariff uncertainties plaguing the hardware sector. There's real fear about supply chains and costs just ballooning. Plus, there is a massive sector rotation going on in the background. Investors are selling anything that looks like old growth or value to chase the shiny new AI pure plays. They are dumping IBM to buy NVIDIA or Microsoft. But make no mistake, while the tariffs provided the kindling, Anthropic absolutely lit the match.
Okay, so that's the bear case. It's compelling. Dinosaur gets eaten by AI robot. I get the panic. It feels logical on the surface. But, and this is why we do these deep dives, does the punishment actually fit the crime?
That's the multi-billion-dollar question.
You've been digging into the 10K and the actual balance sheet. Is IBM actually dying, or is the market just hyperventilating?
This is where we need to step away from the emotional reaction and look at the financial reality. Because if you look at the earnings reports, the whole IBM is obsolete narrative just doesn't hold water. The numbers tell a completely different story.
Lay the numbers on us. Prove the market wrong.
Let's start with the cloud. There's this huge misconception that IBM is just mainframes in a dusty basement somewhere. But over the last 12 months, IBM's cloud revenue hit $20 billion.
$20 billion. That is not a rounding error.
Yeah.
A Fortune 500 company on its own.
And crucially, IBM Cloud specifically is growing at 14%. In a world where the bears are screaming that they are stagnating, double-digit growth in their most important segment is a very different reality.
Yeah, 14% is huge.
This is not a company that is shrinking. It's a company that is transforming. They're successfully pivoting.
14% growth at that massive scale suggests they are finding customers, regardless of what the headlines say today. It means enterprises are actively writing checks. But let's talk about the rest of the balance sheet. In a high-interest rate, volatile environment, cash is king. How do they look in terms of stability?
It's a fortress. And this is exactly what separates a speculative tech crash from a genuine blue-chip opportunity. IBM is a free cash flow machine.
Right.
They generate billions in cash that allows them to do three things simultaneously. They invest heavily in their own AI platform, Watsync, so they aren't left behind. They pay a very healthy dividend to reward shareholders, and they aggressively buy back shares.
Which naturally puts a floor under the stock. They aren't relying on cheap debt to survive like some of those speculative growth plays that crash 30% and just never recover because they run out of runway.
Precisely. This is a defensive stock. They have the war chest to weather a storm. If the economy slows down, IBM has the cash to buy up distressed assets or just comfortably ride it out.
So we have a huge disconnect here. The market sees a dinosaur being replaced by a chatbot. The actual numbers show a cash-rich cloud company growing at 14%. But I want to push back on this a bit just to play devil's advocate for a second.
Go for it.
You mentioned cloud revenue, but let's be real. Amazon AWS and Microsoft Azure are the titans here. They are absolutely crushing the public cloud space. How does IBM even compete? Like, why would I buy IBM Cloud when I can just go to Amazon? Are they just picking up the scraps?
That is the single most common misconception out there, and it's exactly where the nuance lies. IBM stopped trying to beat Amazon or Microsoft at the public cloud game years ago.
They threw in the towel.
They realized they lost that specific war. So they changed the battlefield entirely. They're winning the hybrid cloud.
Okay, hybrid cloud. That's a buzzword we hear a lot in tech circles.
Yeah.
Let's unpack it for the listener who might not be an IT director. What does that actually mean in practice? Why does it matter?
Think of it this way. Imagine you are a massive bank or a global healthcare provider. You have incredibly strict regulations regarding customer data.
Right.
You cannot just take your customers' private financial records or their health history and dump them onto a public server at Amazon alongside some startup's cat photo app.
Right. Data sovereignty issues. It's a nightmare.
It's often illegal or simply too risky from a security standpoint, but you still want the speed, the flexibility, and the AI capabilities of the cloud for your customer-facing apps. You want your mobile banking app to be fast and snappy.
So you need a mix.
Exactly. You keep the sensitive crown jewels on your private on-premise servers, which are often those ultra-reliable IBM mainframes, and you connect them to the public cloud for the less sensitive tasks.
Got it.
That connection, that highly secure bridge between the private vault and the public square, that is the hybrid cloud.
And that is where IBM has planted its flag. They are the bridge builders.
They dominate it. And this ties directly into the Red Hat acquisition. I remember when they bought Red Hat for $34 billion, people thought they overpaid massively. The headlines were screaming that IBM was desperate.
Oh, I remember that clearly. It seemed like a total Hail Mary pass at the time.
But looking back, it was the cornerstone of this entire thesis. Red Hat gave them OpenShift. To keep it simple, think of OpenShift as the operating system for the hybrid cloud.
Okay.
It allows companies to manage their applications across all those different environments. Amazon, Google, their own on-premise servers seamlessly. It makes the insane complexity manageable.
So they aren't just selling the servers. They are selling the management layer that sits on top of everyone's servers. They are essentially the universal translator.
Correct. OpenShift supports over 4,000 enterprise clients globally. And here is the key for investors. Once you build your company's entire infrastructure on OpenShift, it is incredibly hard to leave.
The classic moat. High switching costs.
Massive switching costs.
Right.
It creates a severe lock-in effect. You can't just rip it all out because Anthropic released a new chatbot. It would take years, cost an absolute fortune, and risk breaking your entire banking system.
No bank is going to take that risk.
Exactly. So that revenue is incredibly sticky, it's recurring, and it's reliable.
That's a great analogy. It's like the plumbing of the enterprise. You don't rip out the pipes of your house just because a new faucet design comes out at Home Depot. You might change the faucet, but the pipes stay.
And they have a secret weapon within this moat, too, the financial services-ready public cloud.
A bit of a mouthful. But what does it actually do? Why is it a secret weapon?
It's highly lucrative. They built a cloud environment specifically designed for the banking sector's intense compliance needs. And Bank of America is their anchor tenant.
Wow. Having Bank of America as an anchor tenant is a massive endorsement. That's not some small regional credit union.
It is huge. And it matters because the hyperscalers, Amazon, Google, they're built for speed and massive scale. They actually struggle with the extreme compliance, security, and resilience barriers in the banking industry.
I think so.
IBM has been doing banking for 50 years. They speak the language of regulators. They know exactly what the SEC and the European banking authorities require, down to the letter.
So while the market is completely freaking out that AI is going to rewrite the code, the actual banks are essentially saying, we trust IBM with their security and compliance, and we aren't moving our core ledgers to a startup's AI tool anytime soon.
Exactly. Trust is the primary currency here. And to top it all off, IBM holds over 45,000 active patents.
45,000.
It's a massive war chest of intellectual property. It creates this defensive layer of licensing revenue and legal protection that is very hard for anyone to penetrate. Even if AI changes the coding landscape, IBM likely owns the patents on the processes surrounding it.
Okay, so the fundamental bull case is extremely strong. We have sticky revenue, hybrid dominance, massive cash flow, and a moat built on regulatory complexity. But let's pivot to the charts for a minute.
Let's do it.
Because as an investor, you can be totally right on the fundamentals and still lose your shirt if you catch a falling knife too early. I've been looking at the technical analysis here, and it is fascinating.
What is the price action telling you? Is there a floor here, or is this just a bottomless pit?
It's screaming oversold. When you see a 27% drop in a single month on a mega cap stock, that signals extreme psychological panic. We call it emotional puking of positions.
Emotional puking. Graphic, but it paints the picture.
It really does. It's not rational selling based on valuation.
Sure.
It's fund managers hitting the eject button because they are terrified of their own investors asking why they hold a loser. It's pure capitulation.
Right.
And if you look at the historical context going all the way back to data from 1968, whenever IBM has had a multi-month decline of this magnitude, it almost always sets up what we call a mean reversion rally.
So the rubber band snaps back.
Exactly. Think of price like a rubber band. It has been stretched way too far to the downside. It eventually has to snap back. The price usually bounces back toward the historical average.
Makes sense.
It doesn't mean it goes to all-time highs tomorrow, but the statistical probability of a bounce is incredibly high. The selling pressure simply runs out of steam.
What about the volume, though? That's usually the telltale sign of a real bottom, right?
It is. And that's the other positive signal we're seeing. The volume on this recent drop was unusually high. We call that exhaustion volume.
Meaning everyone is tapped out.
Exactly. It usually means that everyone who wanted to sell, everyone who got scared out of their minds by the Anthropic news has already sold. There's literally nobody left to sell.
Yeah.
And when the sellers run out,
The buyers step in.
exactly. The gap down we saw on February 23rd could very likely be the definitive bottom. The risk-reward ratio here, purely from a technical standpoint, is skewed heavily to the upside right now. You're buying when everyone else is absolutely terrified.
So we have strong fundamentals meeting a technically oversold setup. That sounds like a prime opportunity. But markets look forward, not backward. What actually happens in the next 3 months? What are the catalysts that force the market to wake up and reevaluate this dying dinosaur thesis? We need a spark.
We have the catalyst calendar right here. The big one is obviously earnings, expected in late April 2026.
Q1 earnings. That is going to be the moment of truth.
The narrative battle will be decided right there. The market
Right.
will be watching one thing closely. Will cloud growth beat the AI disruption narrative? If IBM comes out and shows that cloud is still growing at 14% or even higher, and crucially that consulting hasn't fallen off a cliff,
The short sellers are going to get squeezed hard.
very hard.
It's all about the guidance. If management can prove that AI is actually helping their consultants be more efficient rather than replacing them, the stock re-rates immediately.
Right.
If they say, hey, we use AI to modernize our clients' COBOL faster and cheaper, and our margins actually went up, that completely destroys the bear case overnight.
It really does.
Yeah.
And it's not just earnings to look forward to. There are major industry conferences coming up focusing on edge computing, and we expect some big updates on Watson's X expansions.
Edge computing is one of those buzzwords that gets thrown around a lot, but it actually really matters for IBM, doesn't it?
It's a huge growth area. Edge computing is about processing AI data, right, where it's created like at a retail store checkout on a factory floor or on a local utility grid rather than sending it all the way back to a central server.
So it's about speed.
Speed, low latency, and high security. IBM is aggressively positioning itself as a leader there.
It fits their model perfectly. It's highly complex. It requires tight hardware and software integration, and it's heavily enterprise focused. So if we get some good news on Edge or some solid adoption numbers for Watson X, that just adds more fuel to the recovery fire.
Definitely.
But we have to be responsible here. We aren't just cheerleaders. We need to look at the downsides too. What are the actual risks? What if we are wrong?
The ultimate risk is that the market is actually right. The risk is that the Anthropic tool does actually rapidly delete mainframe revenue faster than expected.
Right.
If we see a surprise guidance cut in April saying, hey, consulting revenue is down 20% because our clients are using Claude Code instead of hiring us, then the stock goes significantly lower.
That is the existential threat. If the disruption happens faster than their pivot, they are in real trouble. And the macro risk is still out there too.
Tariffs. If the trade war escalates, tech hardware gets hit hard. IBM is a massive global company. They are highly exposed to currency fluctuations and trade barriers. So that downward pressure is real. If the broader market dumps, IBM will get dragged right down with it.
True. But compared to a high-flying software stock currently trading at 50 times earnings, IBM trading at these historic lows seems like it already has a massive margin of safety baked into the price.
That's the key takeaway. The bad news is already priced in. A 27% drop prices in a total disaster. If the reality turns out to be just okay, the stock goes up.
And if the reality is good, the stock soars.
Exactly. It doesn't need to be perfect. It just needs to be better than dying.
So let's wrap this up with a verdict. I think I know where we are landing, but I want to hear the final score.
I'm ready to call it. Based on the market overreaction, the solid cloud growth numbers, and the highly favorable technical setup.
I'm giving this a bullish score of 8 out of 10.
8 out of 10, that is high conviction.
It is. The strategy here is twofold. Short term, this is a classic swing trade into Q1 earnings. You are betting heavily on the bounce from the historic crash. You are buying the fear while the blood is literally in the streets.
And long term?
It's a multi-year hold. You hold it for the hybrid cloud dominance, the fat dividends, and the fact that they own the infrastructure of the global financial world. You're essentially buying a utility company for the digital age, and you're getting it at a steep discount.
Just tuck it away.
Exactly. You take it away in your portfolio and just blindly reinvest those dividends.
I love it. The elevator pitch is simple. The market completely overreacted to the COBOL fear. IBM's moat, those 45,000 patents, Red Hat, the Bank of America partnership, is vastly stronger than a single AI chatbot release. You are buying a cash flow giant at a 25-year historic discount.
I couldn't have said it better myself.
Before we go, I want to leave everyone with a provocative thought. We keep hearing that AI kills the old guard. The narrative is that data is the new oil, and the new AI companies own the future.
Right.
But think about this. AI models are only as good as the data they are trained on. Who actually has the deepest, most complex proprietary historical data on how the global economy actually runs?
It's not the startups.
It's IBM.
That is a great point. What if the old guard is actually the one best positioned to use AI simply because they are the only ones holding the data that actually matters to the enterprise?
Exactly. Is IBM the victim here, or are they actually the sleeping giant of enterprise AI? Something to chew on.
Thanks for joining us on Smart Wealth with Joshua. We'll see you in the next session.